Well, once again, welcome to retirecoast.com's YouTube video, and we're going to deal with seniors' taxes for the year 2023 in this video. Our title, Seniors Income Taxes 2023, Tax Strategies. Hopefully you have already watched our YouTube video that was produced just before this one that deals with how to complete the 1040-SR or senior form for your taxes for 2023. We want to talk to you now about how to pay the least amount of taxes by withdrawing more money from your taxable retirement income programs, and also when you have breached that threshold of going from paying no taxes to paying some taxes, that you can take a look at the percentage of tax and the dollar amount of tax that you'll pay based on the amount that you withdraw. So we have a couple of things to show you here. We have a spreadsheet, of course, that helps you figure this out. But we also want to talk about the basis of the strategy itself. So I want to show you a chart of the various types of taxable income, and we'll go over those so you understand what those are. And they're also found on the 1040 SR form, essentially from lines 1A through 6B, or if you will, 2B, 3B, 4B, 5B, 6B. This may not mean anything to you because you're not looking at the 1040 senior tax return, but essentially these are tax-exempt interest, qualified dividends, taxable amounts for IRA distributions, pensions and annuities, and taxable interest. And we'll want to go through all of these things so you understand, and then you can compare that with where your money is stored right now, and then use our spreadsheet and some of our strategies as we go forward in this video, and talk about how you can make the most of the tax code. Now, let me just remind you that in 2017, the tax code changed and it substantially improved everyone's ability to take home more money. In other words, keep more of your money. One of the main things was that tax return form, the 1040 SR, was created to simplify the process, and it actually did simplify the process as we discuss on that form. However, there are other detours that everybody takes. I mean, there are so many people in the United States, and everyone has a different set of circumstances. There is dependent care for some and not for others, etc. And the IRS has taken all of this into consideration. So sometimes filling out that form is not quite that easy. You have to take a detour to another form and bring it back. Well, that is somewhat the case with your taxable retirement income. But let's go through that now. So I'm going to bring up that chart. Okay, here's the chart. Now, what we've got listed here is on the left, the source of the income, and then the taxable income, and then just some notes, some information for you. So interest income is taxable, and that's interest earned from savings accounts, certificates of deposit, CDs, and bonds, for example. Dividends are not always taxable. Some are taxable, some are not. And that is another major category that people receive dividends from their stocks and their bonds and other sources. Capital gains, that's profit from selling capital assets like stocks and bonds that you get, and it's a matter of how long you have held these things. So if you hold them for 1 year or more, you're taxed at the lower capital gains rates. You don't need to really worry about any of that right now. I'm just going down to show you what's out there. Rental income, I've mentioned in the other video, you may have some rental income. Some people do, and it should be reportable. If you are one of those that's taking it under the table, well, good luck. If you are reporting it and you've created, for example, an LLC, or you have sole proprietary business, you're going to report this on the appropriate form. We didn't really go into this much in the first YouTube video, except to point out that there was a line there to be completed if it was applicable. But we really want to focus so much on, in this video, on retirement accounts. The traditional IRA account is the key thing, because many of you that had 401k plans have already rolled it over to the IRA, because many of those plans require that at a certain point after you leave your employer. So traditional IRAs, this is where many of you already have your money. It's invested in stocks and bonds and mutual funds and other types of investments through brokerage houses, for example, in your account. And we're not going to worry about the early withdrawals because we're talking to people that are 65 and older here. Then we have the Roth. I'm just bringing this up because the contributions are not taxable. This is not going to affect you, and we're not going to do any work on this whatsoever. I'm just listing it as a source of income. The IRS would like you to report it, but it won't be taxable. It doesn't factor in on your total taxes. The 401k may. Now, there could be some of you out there that were permitted to keep your 401k after you retired. Possibly you have so many years to convert it over, but you're over 65 and you still have that 401k. So essentially the 401k here and the traditional IRA are in the same bucket for the IRS. It's called the IRA distributions line 4A and 4B on the 1040 form, and they don't care which one it is because basically you did not pay income taxes on these amounts, and you're going to owe income tax because these were pre-taxable when you take the money out. The last one is pensions and annuities, and we didn't really deal with that much in the first YouTube video. We just put zeros in there because pensions are mostly a thing of the past. Now, a lot of baby boomers will have maybe something of a pension, but most don't have the pensions that people in the previous generation had. So we just put zero in there. But if you have a pension, then it may be taxable in part. Part of it may not be taxable. And there is a way to deal with that on the form because there is a total amount that you would put into line 5A, which would be the total amount that you received. And then in 5B, you would only put the taxable amount, and that's how the IRS deals with that. So essentially, we're going to be working with traditional IRAs and with the 401ks because you can't do anything about the pensions and annuities. These are already fixed amounts of money that are going to be coming to you. And what we want to talk about in tax strategies is actually deciding how much you may want to remove from your IRA or your 401k. And that's also based on these other income sources coming in too, because you can't really do much about those. You could change your capital gains, for example. You could change your dividends by selling your investment vehicles, those kinds of things. But we're not even getting into any of that here. We just really want to focus on the traditional IRA and the 401k distributions that you would take during the year. So let's move on to talk a little bit more about this strategy. Well, part of the strategy to pay the least amount of taxes is for you to understand the tax brackets. Now, this shouldn't be too complicated for you. In some cases, it's probably just easier to go over this chart with you. But based in 2016, we had one more tax bracket than we have today. So for the majority of you, you won't be dealing with these higher tax brackets here. But there was a big difference in 2018 after the Tax and Cuts and Jobs Act that was enacted in 2017, as I mentioned before. Well, we had a 10% bracket, which will affect quite a few of you, actually, and it affects our example in our tax return for the Sally and Paul Jones tax return, because they ended up not only not paying, but there was a minus $6,406 essential growth space there. In other words, they could have withdrawn more money from their IRA and eaten that up to the point where it was zero completely, and that's what we want to get to here. But I wanted you to see the tax brackets. So you may want to make note of that because you might want to reach a target, for example. But just to show you that the change reduced the second tax bracket to 15%, brought down that to 12% basically here, and then here we are at 12% here. So essentially, you can go to $11,000 of taxable income. In other words, when you get down to line 15 on the tax return, you actually have $15,000 there that the tax tables have to apply to, which means you'll pay some taxes. And then if you want to take that next leap for another 2%, you can go up to $44,000 of taxes, that the income subject to taxes. And then if you want to go to the next bracket, it shows you 22%. But I'm going to stay on these two brackets. And the main reason is you need to draw down your retirement accounts, specifically the 401k and the IRA. You want to take all the funds out of those accounts and you want to roll those back into a Roth IRA or some other brokerage account. And the main reason is that the income that is earned in those retirement programs is subject to income tax because you never paid tax on it to begin with. So as much of this as you can get out of there and put it into some other way that you can continue to earn income, particularly with the Roth IRA, which is tax-free, the better. So let's say, for example, that there's only one IRA account in the family. So this is a joint return we're talking about here. And there are just two individuals, of course, and one of them has the account. Well, the other one can open up a Roth IRA too, and there's a maximum there, which we'll get to, and you can move the money out. And the idea is to move it out at the lowest tax rate possible. You don't probably want to take that jump to 22%. That's an extra 10% that you're going to pay on taxes. If you don't need all of this money right now, you can dribble it out. You can dribble it out at, say, $11,000 a year. You can dribble it out at up to $44,000 a year for as little as 12% in taxes. But if you decide you're going to take a big chunk of it out there, understand that out of that big chunk, out of that, say, 44 to 95,000, 22% of that amount is subject to taxes. So you're going to have to pay the government some of that money. It's not going to be all yours. So unless there's a real reason to remove this money, then you need a strategy to take it out over time, and we're going to talk about that in just a moment. Well, here we are at the Social Security Benefits Worksheet, which if you watched our first video, you will see this spreadsheet. And I'm going to go over this once again for you, just to remind you of the numbers. Now, these are all sample numbers that we put in and for the joint return for Sally and Paul Jones. And we're going to take a look at, this is the actual bottom of that tax return for you. So you can see the source of the income. And again, the actual source of these numbers will be the various 1099 forms that were completed. And we went through a few minutes ago all of the different types of income that come in. And generally speaking, on some of these, for example, qualified dividends, those things, you won't have the flexibility to make easy changes to the amounts that come in. You can if you change your investments and all of that, and that's not what we're going to talk about here. It's an option for you, by the way. It is definitely an option. You can change these if you want more dividends, for example, or if you want to do something that generates higher taxable interest. But the most flexible here, and the key thing, is to drain that IRA account out over time at the lowest tax rate possible. That's what we talked about. So right here we had $9,500. That was strictly arbitrary. when I first put this in as an example. And then we went down to pensions and annuities and we put zeros, but you may have a pension or an annuity. Now again, even if you do have a pension or annuity, this is not a flexible thing. You won't have a choice on the pensions and annuities on what the taxable amount is. And what we want to talk about here is the flexible aspect of planning for. You'll have to put these numbers in, of course, if they do exist, and that will change the amount that you can flex with the IRA distribution, which is the key thing here. Now, Social Security benefits will continue to go up with inflation over time, but we started with 38,000. You might have 40,000, 45,000, 50,000 in here. So this isn't something that you can flex either. And the number that we put into the IRA distributions here, that's your decision alone to take out every year. And it will have an impact on this number in 6B right here, and we're going to talk about that. So I'm not going to go through this worksheet with you. I'd rather that you go to the original YouTube video where we talk about this and we go through it in some detail. However, you can see where the source right here is $3,975, which was actually inserted in here on the tax return form. And that was done by using all the math here that is already done for you and putting in that $9,500 right here. We stick that up there because we needed to do some formulas inside, and that's kind of important. Now let's go down to our planning portion of this spreadsheet. What if I have more income from my IRA? So we have on the line number 1 above, we have $20,000 of income from all of these lines here, basically, okay? And that doesn't include Social Security at this point. It just includes these numbers right here. And so let's go back down again, and that's where our starting point is. Well, now we're down to what if I have more income from my IRA? This is where we're going to do some planning. As I mentioned to you up above, that the flexible part of this income is your IRA account, and that's one of the things we want to drain, get all that money out of that IRA account and get those taxes paid at the lowest rate possible or at no rate. So what I've done is I've looked at this and said, we have $6,225 to play with here before we have to pay the first dollar in taxes. So how much more do we have to take out? So based on some calculations I had already done, I used this spreadsheet to do what if. I have found that you can take out another $2,959 and you'll be down at minus 85 cents, which is essentially a zero. So you're still not going to pay any taxes based on that. You could take out that money and you'd be breaking even. But let's take a look at what it would take in terms of taxes that you would owe if you took more money out. Remember those tax brackets. They started with 10%, they went to 12%, then they went to 22%. We don't want that 22% tax bracket unless you have some emergency, you need to take that money out. But if you can do this over a period of years and take it out at 10% or 12%, that's the way to go. So at this point, with all these numbers in here, we're going to go to put in, say, $10,000. Now, that's a total of 19,000. So we have 10,000 here. Let's go back up, and we're already taking out 9,500. So we've taken out $19,500, basically. So what happens when you change that number to 10,000? It shows that you're going to owe taxes on $13,025. Well, let's go to the tax table and see what that is. Well, now we're at the IRS tax tables, and you can see this these gray letters in here. Basically, this is a draft that will be codified or made permanent sometime in the first week or so of January, but the numbers are likely to remain the same. If there's a recalculation, it probably won't be very much. So we're going to use these numbers as if they are actually permanent. So if you recall, we had $13,025 of income which is subject to taxes. So let's look at the tax table to find the $13,025, and we find it on this line. And right here, I'm not going to go to the top. Well, yes, I will. Okay, right here, married filing jointly. So let's go down right here to 1,303 is the tax that you would have to pay, married filing jointly, on the income of $13,025. So let's pop back over and put that number in and see where we are. Well, we're back, and the $13,025 of taxable income, we have to put in right here the amount from the tax table. So that was 1,303, and here we are. That is the tax that you're going to have to pay, and it comes out to 2.98% of the total income, which is right here. This is your total income right here. So you're paying taxes on 2.98%. The taxable income as a percentage of the total tax due is 10%. So you're basically in the 10% tax bracket. So you have managed to take out more money and pay only a portion of that money. Now keep in mind that of the $10,000 plus the $9,500, the $19,500 that you've taken out in total, you're going to have to subtract this tax because you have to pay this. So you're not going to be able to keep all of that. So basically your taxable income from everything that you brought in this year was $10,500, and the taxes due are going to be $13,300, and this is your net after the taxes right here, okay? $29,197. Now, just for curiosity, you are paying taxes on your non-Social Security income at a rate of 4.46%. I know some of this may be a little bit confusing, but it is a way for you to determine if you can afford to take out more money. So we just took out an additional, say, $7,000 roughly. Remember, we were at $2,959 before break even, so we added $7,000, and adding the $7,000 caused us to have a $1,300 tax bill on that. Well, what ends up happening is you will end up paying taxes essentially on everything because the gross amount starts to grow as you start taking out more money, which means that the tax amount that you pay on everything is just a little bit higher, but you want to stay in that 10% tax bracket or the 12% tax bracket, and this gives you an idea. So you could plan and say, okay, I can take out a total of $10,000 from my IRA, and I will have a tax bill of $1,300. So let's try just taking a larger chunk out and see where we're at. So we're going to go back to the tax table for a moment. Before we do, let's go to $20,000 here. And we're going to have a tax that is due on an income of $31,525. Okay, so this is what you do. You change this number right here, up or down, and put down as much as you want. And now we're going to go to the tax table and we're going to adjust this number. So we'll be right back to this table. Well, now we're at the IRS tax table again, and we're looking for $31,525. Go down here, $31,525 will be on this line, and right here is the married joint return. So we have to write this down of $3,343, and that's the taxes that you're going to owe by taking out the additional amount. So we're going to pop back again to the form, and we're going to put this in our spreadsheet and see what it turns out to be. And we're back. So we have some new tax number to put in here. We're going to put down $3,343 in taxes that are due. And now we're looking at 5.37% or 10.6%. So the number hasn't gone up much as far as percentage is concerned. You're still in the lower tax bracket area, and yet you were able to take out an additional $20,000. So now you are at $29,500 of money that you've taken out of your IRA account and still paid a rather modest tax bill on that. I am saying rather modest. You may think it's a lot, but it could be more. If you were to take out, say, 50,000, that you maybe push yourself into the next tax bracket. The idea is that you can model this using this spreadsheet and determine how much you can afford to take out. Because remember, you're still going to have to pay $3,343 in taxes from this amount. This is what you're going to end up with here. This is your net amount here. And that's the net amount from all of these other income sources, not just your IRA account. So you still have to come up with this amount of money to pay. And since it's more than $1,000, as you can see right here, you're going to have to make a tax payment if you believe that it's going to be more than $1,000. You're going to have to make a quarterly deposit. So this tells you what your tax is going to be, and I would strongly suggest that you use this tool to model the amount you can take out so that you can remove as much as you can from your IRA. I'll just come back up here and give you just some idea. So let's say, for example, over here, that you didn't have any tax exempt interest, or excuse me, taxable interest here, or that your ordinary dividends were very low. Maybe your ordinary dividends were $1,000. By reducing these numbers here, it gives you more to take out here before you have to pay taxes. So really, it's just a combination of all these things together here. So if you don't have these items up here, taxable interest and ordinary dividends that are taxable, then you can take out more money from your IRA account and get to the same point down here. All of that will all work out just based on putting in the correct numbers up here in this Social Security benefits worksheet. That's our spreadsheet. What if I have more income from my IRA? So just keep in mind that the idea is, in summarizing here, you want to drain that IRA account or that 401k account that is taxable at the lowest possible tax rate. And that may take you a number of years to do that. It depends on how much you have in there. If you have $400,000, $500,000, $600,000, $7,000, you're going to have to pick the tax rate that you're comfortable with. Maybe you're comfortable with 22% because it's lower than the next highest rate. But if you can handle that 12% at around $49,000 or so a year, which by the way will go up each year, then you can start to withdraw those funds out year after year after year at the lowest possible tax rate for you. Well, thank you for coming to retirecoast.com and working with us on strategies for your 2023 seniors income tax. Please come back to our website where you can find this spreadsheet, and you can download this at retirecoast.com in the article with the same title, Seniors Income Taxes 2023. And the spreadsheet is available to you. Put it on your computer and use it. It'll be a lot easier to do your tax return and also to do this tax modeling. And if you have seen this before the end of 2023, you may have time to withdraw some additional funds from your IRA account or just use it in 2024. And we'll have another one of these for the 2024 tax year. But this gives you a really good idea during that 2024 tax year about how much you can take out. Actually, the tax tables aren't going to change much. They're going to go up a little bit higher because they are indexed for higher. But one thing I wanted to leave you with is this. That tax change that took place in 2017 and was implemented in 2018 that gave us the simplified tax code, fewer tax brackets, that law is going to sunset after 2024 unless Congress takes action. If you are the type of person who has an interest to see that this law is reauthorized, you may want to contact your legislators, your Congress people, and the senators, and tell them that you want this reauthorized. Thank you for coming to the retirecoast.com YouTube website and listening through our presentation of seniors income taxes 2023 tax strategies. Hopefully you'll come and visit our website at retirecoast.com, and that's where you're going to find the other items you'll need, such as the spreadsheets. You can download those, as I mentioned earlier, and you'll find other articles that are related to finances and retirement. So please enjoy some of those articles, and we wish you luck with your tax return for 2023. Don't forget to come back and check for 2024.